Hello, everyone. Today on the final bar, we do our normal Monday routine, hitting the market from three directions: top-down macro, bottom-up stock picking, sector rotation in the middle. A lot of movements happening today with overall the S&P improving pretty consistently during the course of the day, but the last hour turning on a dime and going downward, showing some distribution. Usually that implies some institutions taking profits, rolling over at the end of the day. We'll see what that means for the long-term trends. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we work through the charts together, focus on the message that the markets themselves provide, focusing on supply and demand, fear and greed, all those emotional drivers of decision-making that manifests itself on the price chart. You may have noticed from the background in the introduction, we are in the StockCharts office today, which is actually pretty cool. It's rare that we're getting back in the office, but we were in here a little earlier recording Chart Madness, which just aired at 5 o'clock Eastern today on StockCharts TV. Had a lot of fun with Tom Boley, Greg Schnell, and Grayson Rose, picking a bracket of 16 stocks down to our 4 top picks. So I'd encourage you to check that out if you missed it. But good to be back in the office for at least one day, and hopefully sooner rather than later. We'll be in here a little more consistently, bringing you some great content and great information. We have wonderful guests on the show. It's one of my favorite parts, having some of the conversations with top strategists, technical analysts. We're very, very fortunate with who we're able to get on the show this week. We have Mark Newton from Newton Advisors on Tuesday. On Wednesday, Samantha LeDuc from LeDuc Trading. And then on Thursday, Doug Bush from Chart Smarter in New York. And as a reminder, Chart Madness, our most recent special, just recorded today, just out today. If you missed it, go to our StockCharts TV on demand, stockchartstv.com, or on our YouTube channel. You can check out Chart Madness. Let's continue on with our market recap. As I mentioned in the introduction, the S&P really rallying through much of the course of the day. And as we were recording the special I mentioned earlier, you certainly had this sense that this is a return to growth with technology, consumer discretionary communication services at the top, the S&P moving higher, the NASDAQ driving it. Now, all of that still is the case with the S&P closing around 3940, the NASDAQ 100 up about 1.7%, but that's coming off quite a bit from where it was around 3 p.m. Eastern. So the last hour sort of gave back, but again, the damage has been done in terms of the upside gains. So the S&P closing at 3940. We look at the chart of the S&P momentarily. Worth noting the VIX is back below 20, which is actually incredibly rare for 2021. It's only the second time that that's happened. The last time was just in the last week or two. 10-year yields coming off, so we're back below 1.7% on the 10-year. The TLT, which is what we usually use for bond prices, up over just over 1%. The dollar essentially flat today using the UUP. Gold flat as well. Silver down pretty significantly, down 1.5% from Friday's close, and commodities overall just flat to down a little bit. Oil prices, same thing, about flat to down. Cryptocurrency is very mixed. There's a lot of volatility, which there often tends to be, but both Bitcoin and Ethereum gave up a lot in the last hour or two, and Bitcoin down around 55,700. Let's look at the chart of the S&P 500. We'll focus on where things are at. We did not have a show on Friday. I was bringing the family back from a week in Eastern Washington, so we missed Friday's show, but very happy to be back with you today. So we didn't get our weekly wrap in on Friday, but looking at a chart, the charts over the weekend and looking at them today, again, the scenario that I'm seeing is similar to what we talked about through much of last week. I'm seeing the market, make higher highs, and I'm seeing the market overall make higher lows. If you look at the low in March and the low at the end of January, and continuing to move higher. The challenge I'm seeing is a lot of divergences, whether it's momentum divergences for individual stocks, whether it's the RSI here on the S&P 500 making lower peaks as the price is going higher. So the new closing highs, the new intraday highs that we made last week were met with lesser momentum than before. To me, that lines up with sort of that overall thesis of limited upside, at least for the foreseeable future, as things continue to churn. I think, you know, what I've seen last week is I say a lot of financial stocks, a lot of energy overbought or very near that, and very much due for a pullback. NASDAQ growthy names, technology, and others that have been beaten down in the short term certainly due for a bounce off of those lows. The question is, is this a new trend? Is this an emerging growth story that now outperforms value in the coming months, or do we revert back to that value leadership themes? We're more upside for stocks like JP Morgan and other regional banks and others. And I would argue for the latter. I think what I've seen is there's not been enough price or time correction yet to unwind the euphoria that we've seen. I think there's more to be done. And again, my base case for 2021 is a lot of choppiness, a lot of volatility. So I'm not surprised we see growth back, moving higher today. I'm not surprised that charts like First Solar are bouncing off of pretty beaten down levels pretty nicely. That makes a ton of sense. The question I have is there the likelihood of a sustained rally from here, pushing those prices materially higher? And I would argue I don't see that as, it's certainly possible. I don't see it as likely though. And so the question is, how do you ride out this sort of volatile period? And in general, it's overall, leaning into the relative winners, leaning away from the relative laggards, and the relative strength that I'm seeing are in things like tobacco names and banks and others, and even energy stocks. So I think there's more upside to be had there. I'm jumping the gun though, unfortunately, going much further on into the show, into things like sectors and stocks. So let's keep it high level here. Looking at the 10-year yield again, I was interviewed last week on a couple outlets, and one in particular was asked about 10-year yields. It's an article on Business Insider about some of the big picture charts, and I showed them this chart, which basically says that we hit the resistance at 38.2%. That's using the high from late 2018. That's taking the low from March of 2020, and then retracing between those two extremes. 1.5% just below that is interesting because that's the 38.2% retracement of that overall move. It also lines up beautifully with sort of mid to late 2019. That was that first major bottom in rates when things started to come up a little bit. And the question was, is 1.5% the bottom, right? I remember that argument. And then when we broke down through that, that was a significant indication that we had further upside in bonds and downside in rates. Now we've gone back above there. And so I'm immediately looking to the next levels. The 50% retracement around 182, and we take it up to 190, which would be sort of the peak. After we bounced in fall, late summer of 2019, we bounced up to around 1.9, just below 2%. And so I could see that being the next item. From a technical perspective, I wouldn't be surprised if we get up around 215, which seems outrageously high. However, 168 seemed outrageously high about 6 months ago. And here we are right at that level. So I think there's further upside. And I think that's why things like financials potentially work more than we may expect, but we'll see what happens. With gold, I tell you what we have not seen is a significant up move in the price of gold very much. And looking at the last year or so of the gold spot price, you have an interesting confluence. We're bouncing off of a low around 1675. That lines up beautifully with May to June of 2020. That was that sort of the first move out of the March lows. We sort of settled in that range and hit support there a couple times before taking off and peaking above 2000 in August. Since there, we've now retraced beautifully on the Fibonacci spectrum back down to the 61.8%, and we're right back at those same levels. I would expect those to hold overall. The fact that we were oversold at the last Fibonacci support level, that certainly feels like a bounce opportunity. However, a break below 1675, I think, opens a much steeper down move than we had. This is all about inflation expectations, or people hedging inflation. You're seeing a little bit of that in the last week or two, but not enough to really signal a bottom just yet. At some point, gold makes a new low, and it's a next sort of valley and price question is, does that stay above 1675, or is that breakdown? I think that will tell us a lot about the potential next steps for gold. That is our big picture, sort of our market recap for today. Let's continue on this process of top level to bottom level. Let's look at the 11 S&P sectors. We always start with the RRG graph. This is my friend Julius de Kempener designed this methodology years ago. I followed it and him and his work for a number of years, and I've always appreciated the ability to visualize rotation of sectors or different assets around the benchmark in the middle. On the weekly RRG, which is where I usually spend most of my time, two things I would tell you, or a couple things. Number one, look at how energy and financials continue to be furthest off to the right. Those are the strongest of the 11 sectors, but look at the last 2 weeks and how you've seen a turn, a right turn, about a 90+ degree turn. I'll call it a 130 degree turn in financials, where you were going northeast, which is thumbs up, improving trend, improving momentum. You can see how energy rotated down. It's almost going vertically down, which means it's still outperforming, but the momentum totally coming out of it. Financials are actually heading southwest, which is what I call the direction of deterioration. The relative strength is going down, and the momentum is going down as well. So it's sort of losing momentum and losing trend. That's not good. Compare those two charts to what you see with communication services, which is heading northeast, and it is the third chart in the leading quadrant. So I think from the weekly perspective, communication services is actually pretty nice setup. And when we look a little later at some of the strongest ranked stocks in the large cap space, not surprisingly, I would say about a third or so of the top 10 scooter names in large caps are in communication services. It's charts like Discovery and Viacom and names that have had some pretty good runs. So not surprising that they've been outperforming and that the sector as a whole is doing okay. On the shorter term rotation, we'll look at the daily RRG, and here's where you can see that this rotation that we've been feeling in the last week or two, certainly accelerating with the things that had been working in the short term: energy, financials, industrials, materials, all rotating southwest. Things that had been struggling on a relative basis: technology, consumer discretionary, even real estate, heading northeast. So the things that are improving are those two most, I would say those three: technology back in the improving quadrant, consumer discretionary, real estate. These are things in the improving or leading quadrant heading northeast. Things in the weakening quadrant and heading southwest: materials, industrials, financials, and energy. So what this shows you is energy and financials have been the strongest, followed by industrials and materials. They're now in the short-term rotation heading down, and that's about what this feels like. And I would argue this is the rotation that we're going to see for a little bit. I think you see a tactical bounce in growth sectors, things like technology, renewable energy, and so forth. I think you see a pullback in things like financials, which have had an incredible run given the increase in rates. The question is that a short-term tactical move before the continuation of the trend we have seen before? I would argue yes. I would tell you, Tom Bowley, who's one of my fellow, one of the three experts I discussed our picks with on the Chart Madness special. He is definitely on the other side, thinking more that this is the reemergence of growth and getting in some of the growthier spaces like tech and renewable energy, things like Tesla that have had these choppy pullbacks, that they're about done, and it's just a good time to get back in and ride them higher. So again, it's all about the charts. Let's focus on how the charts are evolving over time. Having said that, let's look at the 11 S&P sectors using the candle glance function. This is where we can throw a bunch of charts down on the virtual page and compare them to one another. You know, when I was looking at this earlier, what jumped out at me, to be honest with you, is a sector we don't talk a ton about, which is consumer staples. You know, if you just look at the 11 sectors, you'll find things that are just in consistent uptrends. And the consistent uptrends that jump out at me are things like communication services, just lower left to upper right with very little hiccups along the way in the last year. Things like materials, just in a nice uptrend. What else? Financials, again, pulling back recently, but overall strong. Industrials in a pretty good uptrend. But what about staples, which has actually bounced off of its 200-day, making higher lows now, making higher highs, breaking above the previous swing highs, back above the 50-day moving average. Nice bounce today in this sector. And all of a sudden back here, testing long-term highs, all-time highs even, and not quite making it today, but a nice move higher, 1% up, while the market overall in a similar case. So, you know, while it's not the juice, it's not leading necessarily. Overall, the trend is bouncing higher. It's interesting. One of the names we actually had in our bracket of 16 was Altria, Philip Morris, and it's hard to deny the strength that you've seen in this, especially the relative strength. What's most impressive on a chart like Mo is not the price rally, which again is excellent, and I would say the break above 43, which was the high from September, the high from December. That breakout was really meaningful. I think that was a nice, impressive move. What impresses me more than that, though, is the improvement in relative strength. This is a stock that has underperformed for a number of years, especially in the 6 months leading to year end. Just a really ugly space while other things were doing so much better. But look at how this rotation, really starting in February, going higher. And so you have improving price, improving relative strength, extremely overbought. It's rare that I could say tobacco names are extremely overbought, but that's what we've seen. And this is a stock that yields, over 6% using with the dividend component. So some interesting charts in there. And again, while as a whole, it's tough for me to think that's a great asset allocation decision relative to other sectors until you continue to see more improvement, especially in relative strength at the bottom, which we're really not seeing at the sector level. I'm impressed overall looking at just the price return, something that has not been impressive, that is starting to do so a little bit. You compare that with consumer discretionary, it's worth noting both of them really bounced off of their 200-day moving average. Now, consumer discretionary has improved much more after that pullback they both had in early March. You can see the relative improvement here. This is after the sector was hurt pretty bad. Now, a lot of this is Amazon, which is about 25 or so percent of the XLY. So it's a pretty big weight in there. But you see the bounce higher a little bit in consumer discretionary, which is why it's an interesting sector to watch as well. Again, the problem I have with the XLY is it's such a big exposure into Amazon. If you want to find a chart that has done nothing in the last 6 months, you'd be hard pressed to find a better example than Amazon, to be honest with you. It's at the lower end of a rectangle you could draw over the last 6-month period. And in general, I'd much rather own stocks that are improving. You compare Amazon to Philip Morris. It's funny, 6 months ago, I would not have guessed that Mo over Amazon would be a decent pair, but that's the rotation that I've been seeing, and I don't see that changing at the moment. Now, having said that, we get above the 200-day moving average, we find some support on a chart like Amazon. Potentially there's more to come, but on a relative basis, not impressive just yet. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down the action in the markets together using the power of stock charts, the power of data visualization and charting price data over time. The value of doing that, as I was discussing at the CMT Behavioral Finance Seminar on Saturday morning. And if you missed that, I'd go to cmtassociation.org. It's a really cool event with John Knopfsinger, who's a professor up in Alaska. I think it's Alaska Anchorage, I want to say. And then Brian Brogan, who's a professor at St. Joe's, if I remember right, both behavioral finance professors. And we talk about different behavioral themes and what we're seeing. I talked a lot about just routines and decision making and some of the behavioral biases we're able to overcome by having a disciplined process using charts. And really using the power of automation, using things like screening and models to make our lives easier and focus on what we are good at as humans and not what we're not so good at as humans. Having said that, let's go to our next segment, Shifting Stocks, because this is sort of very relevant to what we're going to talk about here. Talk about shifting stocks. A lot of times I'll throw a lot of different tickers that have come up in my process today. I thought we'd look at the top 10 ranked scooter stocks in the large cap space and focus on some of the themes we can see, and then look at the 10 charts together and see what we can tease out. The first thing that I noted as I put these in a chart list today and just looked at them is most of them are down pretty good today. This is a day when the market is up. But if you look, the top 10 scooter ranked stocks on average down today, the only one of the 10 in the green at the end of the day is Viacom up 3%. It's sister stock and communication services Discovery down 3%. That goes all the way down to TripAdvisor. Now, TripAdvisor had announced a secondary offering. It's going to dilute things a little bit, and so the stock down about 10.5%. That's less of a demand change and arguably more of a supply change, right? Additional supply into the shares outstanding that might be affecting that today. But overall, it's worth noting that the top ranked stocks leading into today came off. It's interesting. The scooter rankings are based off of long-term data, medium-term, and short-term data. There's a short-term component, but the long-term data is really the biggest weight. And the reason why I like that a lot is on a day when you see rotation, when you see stocks that have been working don't work as well, it's really obvious when you look at the top-ranked scooter stocks and you see the percent changes just on a day or on a week. So it's kind of an interesting thing to pay attention to. Second thing I would point out as we look, 3 stocks within communication services. I said I thought it was about a third, and that's about right. Half of the top 10 are in the discretionary sector, a lot of retailers and clothing, accessory stores. Then you have 1 financial stock, ADS, and it's really not a bank or anything, an insurance company, a name you probably are as familiar with. And then 1 stock within consumer staples in the personal products group, COTY, C-O-T-Y. Let's go through these 10 charts and see what the trends are telling us. So it's funny, at the top ranked stock in the scooter ranking is Viacom. It's a stock that outperformed today. Again, this is at the end, the latest in a series of days, weeks, and months as the stock has accelerated to the upside. Again, I was asked a number of times during this uptrend when I would talk about Viacom, like, is it too late, right? Have we missed Viacom? And with any of these stocks that have run, and it's similar to things like Tesla, or even years ago, things like Crocs or Starbucks when it's in an extended uptrend. I learned earlier in my career not to be afraid of the new highs list. When things appear on the new highs list, even the 52-week new highs list, that tells you something's working. That's not something to shy away from. That's something to learn more about and see if there's still more potential opportunity. And I think what we've seen over, in recent years, stocks that work have continued to work and have continued to, add gains over time. So I'm not afraid to buy a stock simply because it's on the new highs list. The goal, obviously, is ideally to identify these trends early as they emerge. And that's why looking at new 13-week highs, looking at new 52-week highs are 2 things that I do regularly, and it's try to find when things are breaking out to new highs. Having said that, I still think there's no indication that there's an exhaustion in a stock like Viacom just yet. The price is going higher. It's extremely overbought yet again, which speaks to strong upside momentum and no signal of faltering just yet. The relative strength continues to go up, and overall, I think the chart is in decent shape. You compare that in the short term with something like Discovery, which had much more of a distribution today. So in the short term, it certainly feels a little more on the weaker side, but overall, there's no denying. I mean, today's pullback didn't even get you below Friday's low. So we're still in a pretty good uptrend. I think the trend is still very more positive. While Viacom really accelerated from more of an established level, Discovery really was a non-factor, something that was off most people's radar until probably late November, right, of last year, when it sort of broke out of this base. And then look how it retested the highs from June, and then it was just off to the races, continued up. It spent very little of the last 3 months not overbought. Most of the time has been going higher and higher. Now, again, what concerns me with some of these is you have this bearish divergence in the last month or so. I think that's certainly something to be watching. But as always, you continue to bump up your stock or your risk assessment, and overall, I think there's potential further upside there. TripAdvisor, certainly a frustrating day today with the stock down over 10%. Again, they announced I think it was a convertible offering. I saw some sort of dilutive event that was happening, which is causing price to go lower. Again, this is something that had a bearish divergence as well before today. And the telling candle chart, or the candle signal, this is actually called a gravestone doji, if you know your candle patterns, which is the open and close right at the lows at the same level, and then you have a high upper shadow. You could also consider this maybe a shooting star candle, but overall pretty distributed. This hasn't made new highs up to 65, has not touched that level anywhere near. It's down 13 points, 12 points since making that high about a week ago. So could be potential further pullback. The challenge with TripAdvisor, you have the next swing low is down here around 47. The 50-day moving average may be near to there by the time the stock gets down to that level, but that's what I would look to hold to see if it's able to remain above there. Macy's as well, last week has not been great after potentially trying to break above the highs from late January. It's been unable to do so. Some of the better charts out there have been things like Nordstrom, Kohl's. We're going to look at those in a minute, and it's fascinating to see retailers, department stores up here in the top scooter ranked stocks, but well deserved. The relative strength has been very good. So they're pulling back which is fair. They're pulling back from fairly elevated levels. The question for all three of these, as I go very quickly, as you pull back, do we remain above the previous highs? Do we remain above the ascending 50-day moving average? If so, this could be a good opportunistic entry point on some of these stocks that have had pretty good runs that felt fairly elevated. If not, if they break down through the 50-day, break down through the swing lows, so on something like Kohl's, I'm looking around 52.50. That would be the low from early March. That would be the 50-day moving average. We failed there. I think I'd be a little more concerned about potential for further retracement of the previous gains, but overall, just a strong trend and a bit of a pause within a healthy uptrend is how I would think of it at this point. Cody's an interesting, it's the only consumer staple stock that made the top 10 list right now. You know, it's an interesting one. You think of stocks that are so overextended. Now I'm thinking of most things in the ARK Innovation Fund before they came off, the Pelotons and Zooms and Teslas and all of these, in established trends, things of financials and energies that have gone vertical and now pulling back. Cody's actually a very different look. This is a stock that, hit resistance in December, January, February, now has broken out. Wouldn't be surprised if we retest sort of that 750 to 8 range, which should be the 50-day and the breakout level. It holds that overall. It may be setting up pretty well. And interesting that it's in a sector that there aren't a lot of great opportunities in necessarily. We finish off the top 10 scooter ranked stocks with Tapestry TPR. This is another clothing name within consumer discretionary. Again, no doubt that it's due for a bit of a pullback, but previous pullbacks in January met support at the 50-day, and I think holding that would be just fine. Same with Capri Holdings, CPRI, sort of in a similar state. Strong relative strength, overbought recently, pulling back a bit, not too bad. And then finally, you have ADS, which is the only financial stock in the top 10. Not a bad chart, and I'm seeing right now sort of a similar pattern to what you had back here in the fourth quarter. You had this consolidation in the third quarter, a break to new swing highs in the fourth quarter, then another base, and now a break to new swing highs. I wouldn't be surprised if you get a big pullback and a new base setting up in these current levels. Again, that staying above that breakout level, I think would be really helpful. Sort of that 85 to 90 range is a reasonable pullback coming out of an overbought condition. Is it able to hold that? Overall, it could be okay. So some of these stronger names coming off today and in the recent week or so, nothing to be horribly scared of just yet. As long as they hold some of those levels, I think there could certainly be some further upside in some of those strongest ranked scooter stocks. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the semiconductor ETF SMH. One of the matchups we had in our Chart Madness special we recorded earlier today was Intel versus NVIDIA. A number of us made the comment that semiconductors as a whole are a really fascinating group to look at. I personally would not be surprised if semiconductors have more backing and filling to do, but I can't deny the fact that the group is rallying pretty good today. This group holds up well. This group rotates back higher and makes new highs. It would be hard to be too bearish on the prospects for stocks overall, especially the sort of growth trade, because that is speaking to a healthy environment. Chart number 2, airlines. Airlines came off pretty good today, one of the worst groups, with the Jets ETF down almost 4%. This is coming off of a pretty overbought level for the Jets ETF. It was overbought in February as well, pulled back a little bit, didn't even make it to the 50-day before rotating higher, but it did pull back to the breakout level around December. So 24 to 25, you'd want to make sure that holds. If not, I would start thinking a little more about potential for further downside. Finally, JP Morgan, JPM. I will tease my pick out of the 16 stocks earlier today in Chart Madness was JP Morgan. And I did that with the thesis that the banks like JP Morgan have certainly benefited from higher interest rates. Rates can come down a little bit in the short term. I think that makes a ton of technical sense and tactical sense. Overall, though, I think there's potential for further upside, and I would not be surprised if a chart like JP Morgan starts to work after a brief pullback. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. Go to StockChartsTV.com, set up a free account. You can watch all of our content on demand. Also, if you missed our special Chart Madness, check it out on StockCharts TV on demand or our YouTube channel. For StockCharts TV in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.